You pick up your phone, swipe a few times, and the first feeling isn't sleepiness. It's unease. One article says, China is about to overtake the US, building more highways, high-speed rail, deep-water ports, chip factories, warships. Two swipes down, you see the opposite. China's property bubble bursts. Debt time bomb quietly ticking. Shadow banking and local governments run out of money. Same country. Two completely opposite stories. Now try changing perspective. You're not sitting in Vietnam, the US, or Europe, but in a small apartment in Chongqing, Shenzhen, or Chengdu. For the last 30 years, your family has lived inside a very simple story. Work hard, get into university, move to the city, buy an apartment, trust the state, and China's rise will lift everyone. Your parents watched their lives jump from bicycles to cars, from shared housing to 2 or 3 apartments, from ration coupons to brightly lit shopping malls. But now, when they open their phones, they see something different. Tech companies cutting staff, real estate developers delaying handover, news headlines about hidden local government debt, municipal bonds, property giants missing payments. A few friends can sell their second or third apartments, the ones they thought would fund retirement. The story of always going up has a small crack in it, and that crack is getting clearer. This video is called China, Debt and Power. Can Beijing escape the cycle? Because that's the real question. Not China is about to collapse, or China is guaranteed to dominate, but this. Can any great power use debt to turbocharge growth this fast, for this long, and still bend history to its will? Can it escape the familiar cycle of rise, overuse of debt, reckoning? And more importantly, how does that cycle hit your wallet, your pension, your savings account, whether you're in Beijing, Saigon, or New York? To understand China today, you have to step back and look at one of the oldest patterns in financial power, the rise and debt cycle of empires. Let's take a quick tour. In the 16th century, Spain shipped silver and gold from the Americas to Europe in quantities the continent had never seen. For a while, it looked like free money. The crown could pay armies, build fleets, fund wars, buy influence. But easy money, just like easy debt, has a side effect. It lets you postpone the hard stuff. Structural reforms were delayed, domestic industries weakened, debt piled up, inflation ate into real wages, Spain defaulted again and again. The empire didn't vanish overnight, but it started to weaken long before the gold and silver stopped flowing. In the 19th century, it was Britain's turn. The pound sterling became the world's reserve currency. London financed railways in India, ports in South America, mines in Africa. British public debt rose, but so did overseas assets and income. The empire looked unstoppable until 2 world wars shredded its finances and manpower. After 1945, the US stepped up, with the dollar as the anchor of a new monetary system. The US borrowed to build highways, suburbs, wars, factories, technology. And like every empire before it, there came a point where debt became the default state, deficits became a feature, and financial markets ballooned far beyond the real economy. Japan in the 1980s was another verse. Export miracle, super savers, a giant bubble in stocks, and real estate, then a crash, and decades of slow growth with huge public debt and near-zero interest rates. If you sketch the curves, power, debt, confidence, you see the same song. Rapid rise, debt used as fuel, then getting stuck in the very engine that carried you upward. Now put a dot on the map. China, 1978. Deng Xiaoping begins reform and opening. The formula for the following decades is brutally clear. Move hundreds of millions of people from farms into factories and cities. Pour concrete into roads, ports, power plants, towers. Plug into global supply chains. Keep wages low, manage the currency. Use credit as a jet engine. If you've ever flown over a Chinese city at night and looked down at layer upon layer of apartment blocks, highways, and industrial zones, you've seen that formula turned into concrete and steel. For years, the world told a simple story. China is catching up. Copying, importing technology, adding labor. What many people didn't look at closely was the financial plumbing underneath. China's growth model stands on 3 legs. First, state control over the banking system. In the US or Europe, most banks are private, under pressure from shareholders and profit targets. In China, The big four banks and many major institutions are essentially arms of policy. When Beijing wants to pump money into the economy, it can literally pick up the phone and push credit out into the system. Second, local governments. They don't get to print money, but they do have land. For many years, they've taken farmland, rezoned it, and sold land use rights to developers. Land sales became a primary revenue source to build roads, bridges, stations, parks, squares, science cities, industrial parks, and most importantly, to hit GDP targets. The higher the growth number, the brighter a local official's career prospects. Third, real estate. In China, apartments aren't just places to live, they're the main savings vehicle. Financial options are tightly controlled, deposit rates have often lagged growth, the stock market is volatile, foreign assets are restricted, so most households jam their wealth into property. The first apartment is to live in. The second, third are investments. For years, prices only went up, and that seemed to prove the choice was correct. If you wanted to design a growth engine based on credit, it would be hard to come up with a cleaner structure. The central government sets slogans and credit direction. State banks open the taps. Local governments set up financing vehicles, LGFVs, to borrow for projects, repaying with land sales. Developers borrow from banks, issue bonds, tap shadow banking, use that money plus buyers' prepayments to buy land, build, then sell, each cycle bigger than the last. Households take on mortgages, parents chip in, everyone running around a single belief: that the line of housing prices will keep going up. Exports bring in foreign currency to build up reserves and reassure the world that the system is solid. Under the surface, leverage at almost every link is rising. But drop the jargon for a moment and look through the eyes of people living in it. Li is a young man from a small village in Hunan province. At 20, he heads to Shenzhen as a construction worker. 15 years later, he has worked on almost every kind of site: apartment towers, highways, malls, stadiums. He sleeps in damp dorms with 6-8 people, sends most of his pay home so his parents can fix the family house and buy a small apartment in the nearby town. To him, debt is something far away. What he actually feels is this: as long as things need to be built, as long as cranes hang over foundations and drills bite into concrete, there is work, there is pay, there is hope that his son can study in the city. Zhang is a local official in a second-tier city. She started in a minor role on the city committee and gradually climbed to a deputy mayor position in charge of the economy. Every year, the targets from the province and the center are crystal clear: GDP growth, jobs created, major projects attracted. The easiest way to hit them: borrow through the city's financing company, build a new road, a new bridge, a new industrial park, a new high-tech zone. Each project adds to GDP during construction, creates a nice backdrop for photos with higher-level leaders, and might, if you're lucky, attract some real factories. Debt rises. But as long as this year's growth figure looks good, she scores points and moves up. Chen and Mei are a young married couple, both university graduates, working at an internet company in Chengdu. Their income is far above their parents'. As soon as they've saved enough for a down payment, both families push them. Buy an apartment as soon as you can. Prices will only go up. Don't wait until you can't afford it. They throw in all their savings, borrow heavily, and buy a unit on the edge of the city in a brand new development. A few years later, incomes rise, friends show off their second apartments, and they follow. An investment. For our child. The entire wealth of the couple and both sets of parents is now mostly sitting in 2 property titles and a stack of mortgage obligations. Li, Zhang, Chen, and Mei, none of them think they're playing with a debt bomb. They're living the story the system told them. China is rising, the state is guiding. Real estate is a safe asset. That story isn't just propaganda. It's the lived experience of hundreds of millions of people for decades. It gave them the confidence to borrow, to invest, to sacrifice. The problem is, no growth model can run forever on the same fuel. When China was poor, each new bridge, factory, or industrial park clearly added value. Goods were scarce. Labor was cheap. Anything you built would almost certainly be used. But once you've built a nation-spanning high-speed rail network, deep-water ports, north-south and east-west expressways, a significant share of new projects are more like another layer of makeup on the picture than a new foundation. In some places, expressways are empty, airports have few flights, industrial parks host only a handful of factories. Each project still adds to GDP while it's being built, but it doesn't generate enough cash flow to service the debt. At the same time, the population begins to age. The workforce no longer grows like before. Wages rise, eroding the ultra-cheap labor advantage. The outside world changes. Trade tensions, tech wars, reshoring of supply chains. All of that slows growth. And when growth slows, the weak points of debt become much more visible, especially in the real estate pillar. For many years, buying property in China was almost a guaranteed win. As long as prices rose steadily, nobody felt leverage was dangerous. But when income growth slows, the young population shrinks, and the supply of apartments is already enormous. The story, "housing only goes up," gets stretched. In some third- and fourth-tier cities, prices stall, transactions fall. A few giant property developers, who lived by borrowing and rolling one project into the next, suddenly can't roll anymore. They miss bond payments, delay paying contractors, leave projects half-finished. People like Chen and Mei suddenly see the construction site below their building frozen. They still have to pay the bank every month for an apartment that isn't finished. In some areas, buyers organize mortgage boycotts, declaring they won't pay another cent until construction resumes. For banks and authorities, that's a nightmare. If large numbers of people stop servicing loans, financial stability itself is threatened. The central government responds with a mix of hard and soft. It introduces the 3 red lines to cap developer leverage, sending a message. The era of endless growth fueled by debt is over. It repeats the slogan, "Houses are for living in, not for speculation." It pushes local governments and banks to prioritize finishing pre-sold homes, to avoid leaving millions of people stranded with no home and no money. It injects liquidity when needed to prevent a system-wide freeze, but tries to avoid creating the impression, "Borrow recklessly, the state will bail you out." Even so, the numbers don't disappear. Local government debt, much of it via LGFVs, is high enough that even official data can gloss over it. Funds raised through shadow banking and wealth management products that once hid real estate risk begin to show cracks. Savers, if they read the fine print, realize that the slightly higher interest they were promised is the price for shouldering deeper risk in the chain. Across the border, the story of debt and power takes another shape. The Belt and Road Initiative. For over a decade, Chinese banks and companies have financed and built ports, railways, and power plants across dozens of countries. For many recipients, this looks like a chance to build infrastructure faster, bigger, than if they waited for traditional international loans. For China, it's a way to export excess capacity in steel, cement, and construction, to create jobs, and to build influence. But overseas infrastructure, too, obeys basic arithmetic. If the road, power plant, or port doesn't generate enough income, or if the borrowing country hits a crisis, the loan becomes a burden. Some projects have been delayed, some loans need restructuring and extensions, and in some places political debates flare over debt traps. Again, the line between strategic ambition and financial risk is blurry. So what does it really mean to ask, can Beijing escape the cycle? Historically, when great powers slam into a wall of debt, they tend to have 3 main exits, not counting crash spectacularly. First, inflation and financial repression. Let inflation run higher than interest rates, quietly eroding the real value of debt while savers and wage earners take the hit. Second, default or restructuring. Openly admit that some debts can't be paid in full. Cut, delay, swap, take the pain in one visible shot. Third, the long grind. Accept slow growth, low rates, and let banks and the state together kick the can into the future, as Japan did, avoiding a giant crisis, but living with decades of stagnation. China does have a couple of advantages. Spain, Britain, or Japan didn't have at the same stage. One is the degree of state control over the financial system and capital flows. The government can instruct state banks to roll over loans to local governments or systemically important developers, hiding bad debts longer. It can keep deposit rates low, creating a spread that lets banks recapitalize slowly by paying savers less than the economy earns, a kind of invisible tax on savings. Second is the ability to control information and sentiment. In open systems, bad news spreads fast and can trigger a full-blown confidence crisis. China can stamp out narratives that cause panic, control news flows, crack down on rumors. That doesn't change the underlying financial reality, but it can buy time to work on problems quietly, avoiding a stampede for the exit. Third is that there is still genuine room to rebalance the model. If China truly pushes its economy away from dependence on construction and real estate, toward domestic consumption, high-tech manufacturing, and higher-value services, and if productivity really improves, then the debt burden becomes much more manageable than in a scenario where growth continues to slide. But there are also constraints that no political power can erase. An aging population means fewer workers supporting more retirees. Productivity cannot be commanded into existence. It needs innovation, competition, and tolerance for failure. Things that struggle in a tightly controlled environment. The outside world is no longer the sunny, happy globalization of the 2000s. Geopolitical rivalry, tech sanctions, investment restrictions in advanced sectors all create new ceilings for export-led growth. And then there are people's expectations. A generation that has only ever known next year will be better than this one will react very differently to a decade of okay but not really improving, or worse, to their assets being eroded. All of that is not just China's problem. It hits you in multiple ways. If you invest in resource companies, luxury firms, energy, tech, odds are a big chunk of those companies' revenue comes from Chinese customers. If you hold emerging market ETFs, Asian bonds, or even just work in an export industry, tourism, or commodities, then China's debt and growth trajectory is a background force you cannot ignore. So what are you supposed to do with all this, beyond nodding and thinking, yeah, that sounds scary? First, look at your own portfolio and ask, how much am I implicitly betting on China being able to play the same game for another 10 or 20 years? Not just in China stocks. It's also that iron ore miner whose main customer is Chinese steel mills. That luxury brand living off Chinese buyers of bags, watches, spirits. That Vietnamese, Thai, Malaysian company dependent on Chinese tourists or Chinese-sourced inputs. If a Japanification scenario, slow growth, high debt, weaker consumption, unfolds, all of those income streams will look different. Second, use this story as a mirror, not a punchline. The rise debt reckoning cycle is not a China thing. The US, Europe, Japan, and many emerging economies are on similar curves, just at different places in time. Whenever you hear a politician, analyst, or brand ambassador talk about public debt, deficits, stimulus, remember the examples: Spain with precious metals, Britain with its empire, Japan with its bubble, America with Wall Street, China with concrete and apartments. The real questions are always, what is this debt being used for? What productivity does it create? And who will bear it in 10-20 years? And where do your bank deposits, bonds, and pension funds sit in that equation? Third, choose a humbler attitude towards certainty. The loudest voices on China as future tend to cluster at two extremes. Collapse is imminent, and dominance is inevitable. Reality almost never sits on either end. Most likely we'll see something messier. Some regions and sectors boom while others die. Some cities become innovation hubs while others turn into museums of the bubble era. Some debts are quietly erased, others painfully restructured. If your portfolio only works in one extreme, total China implosion or total China hegemony, you are not investing, you're gambling. And finally, remember this: nobody escapes the cycle completely. Even if Beijing manages things well and avoids a big crisis, it still has to live through a phase where debt, power, and expectations collide. Living through that period, whether you are in China or outside, requires something markets are very bad at: memory. Memory that every economic miracle has a price. Memory that every time we use debt to pull growth from the future into the present, we are also pulling risk from the future into the present. Memory that there is no model that gives you high growth, low interest rates, low risk, forever, just by trusting the system. If this video helps you see China debt and power, can Beijing escape the cycle? Not as a prediction game, but as another chapter in a very long story about how great powers play with debt, don't let that realization evaporate. Hit subscribe so that next time someone confidently declares China is about to collapse, or China will rule everything, you hear a third voice in your head. What does the debt story say? What does the cash flow say? Where do ordinary people sit in this? Leave a comment about how China's rise or slowdown has already touched your industry, your job, your financial plans. And the next time someone tells you they've found a way to grow without paying a price, you'll be able to smile and answer, no one escapes the cycle. They only choose how they're going to endure it.